Hi, everyone, and welcome. Sorry for that delayed start right there, but thank you for tuning in to today's webinar on year-end tax planning strategies to use right now. My name is Nancy, and I'll be your moderator for today. You can ask me any questions if you have any technical issues, and I'll be happy to help you. Before we dive into our presentation, I just have a few housekeeping notes to mention. First, everyone is muted to limit disruptions. If you have questions, use that questions feature of your GoToWebinar control panel, and we will follow up with you guys after the webinar. This webinar is being recorded, and you'll receive a copy of it tomorrow in your email along with a copy of the slide deck. And finally, upon leaving, you'll be prompted to complete a very short survey. Please take a moment to share your feedback with us. We'd love to know what you thought and what other topics you would like us to cover in the future. With that, I'm going to turn it right over to Andrew Kent, our shareholder in tax and accounting and healthcare litigation, to get us started on this presentation. Andrew?
Thank you, Nancy, and good afternoon, everybody. Thanks for joining us. I'm Andrew Kent with Saltmarsh, Cleveland & Gunn, and today Mike Cole is joining me, and we're going to spend the next half hour or so walking through some year-end tax planning strategies that you can put to use right now. So without further ado, because we're on a tight schedule today, we're going to go ahead and jump into the next slide. So our agenda today, business planning, what can we do at year-end? So we're going to go over a number of topics today. We're going to talk about PPP loans and the related forgiveness. We're going to talk about employee retention credits, renewable energy credits, gain acceleration on investments, accelerating expenses, gifting and bargain sales, ESOPs, divisions, spinoffs and reorganizations, and new state filings. We're going to start the discussion today with a discussion on PPP loans and forgiveness. So the payroll protection program is probably something everybody on this call has heard of today. It officially closed on May 31st, 2021 for new applications. And so most borrowers have already been through their complete covered period and have applied for and received forgiveness. However, there were borrowers who came into the program late for a round one application, or who had a second draw application that was not taken out until May. Those borrowers may still be in the end of their covered period, may be approaching forgiveness. So remember, the key thing there is you have 10 months after the end of your covered period to apply for forgiveness before payments start becoming due. From a tax perspective, from a planning perspective, you should keep in mind that your PPP loan forgiveness is specifically excluded from gross income for federal tax purposes. So typically loan forgiveness is income, but PPP loan forgiveness is statutorily excluded. PPP loan expenses are still considered deductible expenses, and so you may have a situation where you may have more net income or more cash at the end of the year than you might normally have for a given level of profitability. The loan necessity questionnaire is something we had a lot of questions about. This was early on, the SBA was looking at loan necessity in order to determine if the loans were necessary and eligible. This is something that was actually terminated over the summer. So if you got one of these forms back early in the year and are wondering what happened to it, the SBA ultimately decided to get rid of their loan necessity investigation. And so these forms are no longer out there. So Mike, any comments you want to have on PPP loan forgiveness or anything else?
Yeah, just when you think about loan forgiveness, oftentimes we're thinking about, end of years coming up and draws are happening with a lot of our shareholders and partners kind of as we're looking at what income looks like. One area is if you're close to the line and you might either think that, you're going to be, you might not have enough taxable income to take a draw in the current year. The PPP loan actually typically increases your basis for both S corps and partnerships, because even though it is a forgiven loan, it's technically considered tax exempt income, which is an increase to many basis calculations. So while it might not be necessarily a perfect cure, there might be a little bit additional basis for you to be able to take some distributions or some draws from your accounts. But obviously you would have to call one of your tax professionals to make sure that that's, going to hit your capital account the way you're expecting.
Yeah, no, excellent point. So moving on from PPP loans and forgiveness, then we've got there were some updates in the ARPA, the most recent coronavirus act that changed or tweaked the payroll costs that were eligible for PPP loan forgiveness. So once again, for most of you out there, this is water under the bridge. You've already filed for and received forgiveness. But just keep in mind, if you haven't filed for forgiveness yet, there are certain payroll costs that aren't eligible for PPP loan forgiveness. And these include the wages that are used to calculate employee retention credits, something we'll talk about in just a second, the wages used to support disaster credits, and premiums for COBRA continuation coverage that are used to support a tax credit. The basic rule is no double dipping on credits or on federal programs. Mike, anything you want to add there?
Yeah, just going the opposite way, where the PPP loan forgiveness typically gives you extra basis to be able to take a deduction. Taking the ERC is actually what's referred to as a supplemental expense credit. And so because of that, that's actually going to reduce your basis in your company. So, it might be one of those things where your taxable income and all, and you've got several different pieces of fluctuations from your tax exempt income and your non-deductibles. These credits are actually going to reduce your basis for the most part under most circumstances. So just be aware that, there might be some offsets there and your basis might be a little bit lower if you didn't get the PPP loan, but you are getting the employee retention credits. Your basis in your company might be a bit lower than what you're expecting.
Good point. Employee retention credits and eligibility. This is something we're still getting a lot of questions about because it is a program that has gone through multiple iterations over the last year and a half. The employee retention credits, or ERCs, are refundable tax credits that are applied against the employer's share of Social Security tax obligations. The credits were created by the CARES Act, then modified and extended by the Taxpayer Certainty and Disaster Relief Act, also called the Relief Act, and then modified again by the American Rescue Plan Act, the ARPA. Credits for 2021 can equal up to 70% of $10,000 in qualified wages per calendar quarter. So the credit potential is substantial, particularly for organizations that have a lot of employees. In general, there are eligibility criteria. You have to have operations that were fully or partially suspended, or you have to meet certain revenue decline tests. And we've highlighted here, we could spend probably the next 20 minutes talking about eligibility for ERC credits. It's really something, if you think you might be eligible, if you had a decline in revenue, or if your operations were suspended, you really need to consult with a professional because the rules have changed at least 3 times in major movements. And you kind of need to understand where you are, how you might qualify, whether you qualify for one of the specific safe harbors that are available, and look at your situation to determine if the ERCs are a good idea. You still have flexibility to look at ERCs. As we just touched on, you can't use the same wages for ERCs and PPP loan forgiveness. You can't double dip. You also have to keep in mind that ERCs are going to reduce your employer your wage expense as an employer, and therefore reduce the corresponding deduction. And so there could be a situation if you're applying for credits retroactively back in 2020, that you might actually have to go back and amend your return for 2020, I think. So just something to keep in mind there as you look at ERC credits. Anything you want to add there, Mike, before we move on to credits, renewable energy credits?
Only just kind of holistically with all these incentives and credits programs. Right now, we're seeing a really hot M&A profile out there in the community. And as you're thinking about, what you're going to include in your EBITDA and what are maybe some things that you should be excluded from your EBITDA as you're talking to potential acquirers, or you're thinking about selling your business, or you're thinking about buying a new business from somebody else, a lot of times these employee retention credits and other kind of infusions are what are commonly referred to as one-offs. And so as you're sitting down with your business advisors, be thinking about some of these as maybe some actions where you could say, hey, this is revenue, and we really would have had a lot more revenue in our year had we not had suspensions of our services or whatever it might be. And so just be thinking about, not just these as credits, but thinking about these as your holistics, whether you're going out for new financing to buy a new piece of equipment or you're thinking about selling your business. A lot of times you have to be able to tell the story around these pieces.
Now that is a great point, Mike. I mean, we are making lots of adjustments right now in valuations that are being done in 2021 to remove or normalize out these one-time events, right? PPP loan forgiveness, ERC credits for providers in the healthcare space. You're talking about provider relief funds that can also interact with all this. So that is a great point. Whether you are on the sell side or if you are looking at acquiring, you need to make sure that the business you're looking at, that you're normalizing or adjusting for all these one-time credits and events. So great point. So Mike, I think the next slide is you. We'll move on to renewable energy credits.
Yeah, so this one is near and dear to my heart. When I think of year-end planning, the solar and wind renewable energy credits, what's commonly referred to as the ITC, the investment tax credit, is one of my favorite go-tos, because oftentimes, as long as you have 5% in to the investment, you can actually lock in a credit for this year that you can also carry back to last year and take bonus depreciation next year. So all of a sudden it becomes a 3-year planning opportunity. So say you didn't get the planning done that you need to get done last year, you had an audit adjustment, whatever it might be, you can now take away the income that you had last year using credits. You can knock out this year's income using credits, and then you can carry that depreciation under bonus depreciation, taking 100% of it next year. And it really becomes a really awesome planning tool. On the back end, what's really interesting is that a lot of folks like these investments because they have long-term, they typically have 25 or 30-year cash flow streams. And even though the cash flow kind of slows down after the first few years, there's still enough there that you can do trust and estate planning with, using that to buy long-term life insurance, investing into other annuities, taking those funds to invest in a mutual fund or other stock market, and then using intentionally defective grantor trusts or other tools to shift that value when it actually has a kind of by normalizing the return on the cash from, a 30-year stream to today, you can take a pretty big chunk out of that value, gift it over to somebody else, and get all the tax benefits in the current year, and then give a nice gift to the next generation going forward. And it's really an excellent planning opportunity, as long as it makes sense financially to do so, right? Like, you have to look at each one of these. Honestly, the big problem that we run into in this area is that some developers are not as skilled as others. And so it's really important to make sure that you have a whole team approach if you're thinking about doing this. It's not just, oh, I went out and got credits from, this person on the street that I knew through a handshake. It's making sure that everything gets vetted, the documents are done correctly, to really maximize the benefits of these and make sure that you're not walking into what could be a very bad situation. Andrew, I mean, have you experienced using trust and estates or using credits or other kind of planning tools that, especially kind of last minute at the end of the year?
Yeah, we're definitely seeing, in the last couple of years, I think some renewed, some interest in this area and these credits as more and more people are becoming aware of them, and we're just seeing more and more development activity, out there in this space. So absolutely a great planning tool, something to consider. Mike, I think the next slide is business planning methods and periods.
Yes, so we know now, at least from what's been put out by the various congressional committees, that it looks like we're not going to have an increase in rates for next year. But we also know that we're also expecting a lot of booms, as well as maybe first quarter payments for things that had dragged out or slowed down during this year that are going to kind of either hit at the end of this year, or you're going to get that cash flow early next year. And so your revenue streams right now are probably looking a little bit in flux as we head towards the end of the year. It's a very common thing right now that we're seeing with a lot of our clients, especially in the manufacturing area. And so one of the things that you might want to consider doing is accelerating some of your portfolio gains, because if you have maybe some losses in the market that you took early as you were thinking about doing a reinvestment strategy, whatever it might be, now might be the time to kind of reinvest or sell out your current funds. Wait until, a little bit into next year. It's normally called the 60-day rule, 61-day rule, which is 30 days before you can't buy the same stock. The day you sell it, you can't buy that stock, and 30 days after you can't buy the same stock. But, you sell it on December 31st, you can buy it again on January 31st. And, there are a lot of taxpayers that utilize this in a down year when maybe they don't have as much, or maybe they have a big overpayment from last year that they were expecting to have to use. They kind of accelerate those gains so that way they can increase their basis as either a part of a transfer strategy or an overall market strategy to kind of normalize their taxes and help prevent massive tax gain events in singular years. Andrew, have you had clients kind of thinking about where the market's going and what they're seeing and what they're doing? I mean, what are kind of the forecasts that you're hearing?
Yeah, I mean, it just depends. everybody's, obviously the big question in everybody's mind has been what's going to happen to the rates, right? And that's driven a lot of interest in getting businesses valued and that sort of thing. I personally, with my clients, hadn't had a whole lot of conversations around the need to accelerate base, sell and accelerate basis, try to accelerate some of those gains in the current period, that sort of thing. I think people are still, most people are still trying to get around the idea of what's going to happen after the first of the year. And most of our activity I've been seeing has been around, do we need to have our business valued this year? Or do we need to be looking at some kind of, gifting strategy for the current year? So.
Yeah, Andrew, I think that makes a great point, because while we're not seeing it in the current set of bills, a rate change for capital gains or ordinary income, there's still going to be a reconciliation next year. There's still going to be a budget for next year, and there could be retroactive income changes to income percentages. We saw, I think it was back in 2016 when they changed the percentage on long-term capital gains from at the end of the year to be retroactive back to the beginning of the year. And so, kind of depending upon where you sit and what you think is going to happen in Congress and with the presidency, that obviously could have some impact as to whether or not you think it might be even more beneficial to accelerate some of those gains as well.
Absolutely. All right, on to accelerating expenses.
This is another one that we've seen a real lot of movement in, especially lately, as companies have had a real spreading out of their work personnel. And it used to be what's called 263A, which is how much of your inventory, how much of your overhead you have to capitalize into your inventory, was kind of a methodology where people had very kind of set in stone processes, right? They looked at it and they said, well, all of our people come to the same building, our salary expense is roughly the same every single year. Therefore, we're going to capitalize, 1% of, these 5 tranches into our inventory at the end of each year, as kind of a part of our capitalization process under 263A. Well, now that we're seeing so many people working from home, we're seeing a number of organizations work with a lot fewer people, or they can't find people, and so they can't produce the type of goods that they're used to looking for. We're finding a real large amount of opportunity here to take a look at their capitalization methodology and examine whether or not there can't be some benefits in examining how they do the 263A approach. And should that fail, there's always the classic: buy it on your credit card on December 30th or in the middle of December. Your credit card statement's not due until January 6th, and all of a sudden, whether you're a cash method or an accrual method, doesn't really matter. You can actually take that deduction in the current year and kind of pay it off in the next year. The one thing I like to make mention of this is that if you're thinking about doing accelerating expenses, either by pulling on a line of credit to kind of make a large purchase, or you're going to use your credit cards, whatever it might be, oftentimes there's a cost of capital expense that exceeds the benefit that you're going to get from the tax deduction in the current year, as well as once you start that cycle, if you do it in a big way, it's often very hard to get out of that cycle. Where if you're drawing on your line of credit to make a really big purchase this year because you had a lot of income, and then next year you have a lot of income too, well, now you've already drawn on your line of credit, you've paid for that use of capital, and now you might need to do that again in order to try and offset your cash flows. So a lot of times it takes a real strong amount of planning and cash flow management if you're going to make a plan like that, to make sure that it's a good couple-year plan, not just this seems to make sense right now, which is where I think a lot of advisors tend to get caught up in a trap. They're like, take the expense right now, and they forget about the 4% you got to pay for drawing on your line of credit, right? Right. And so there's just a lot of little pieces there.
It ultimately comes due at some point. No, I think those are great points. Bargain sales and gifting.
This is another one where, Andrew, I'm not sure if you're seeing a lot, but I'm seeing a lot of folks get very interested about this because there's such a wishy-washy approach to the economy right now that there are a lot of organizations that feel that now is the right time. They've had a down year or two for 2 years of COVID, even with some of these exclusions and other pieces. If they're going to make a gift to the next generation, they want to bring somebody in at a low value, whatever it might be, now is kind of the time to do it, especially with the exemption right now being at $30,000 for a married couple. If you have a family organization that you own, you can take a minority ownership discount, you can do some other little fun things relating to the valuation, and then all of a sudden you get another $30,000 on top of that. you can start transferring some real value to the next generation without really kind of bumping up against any of the large lifetime kind of exemptions that you get. The other side to this is that there have been several cases that came out this year that said if you have a bargain sale to a related party within your family, that it actually counts as a part of a gift. So let's say that, you know, you're looking to move some of that value to the son, to your son or your daughter, whatever it might be, but you don't want to get out without getting any money back. Well, now you can almost structure it to be a part sale, part gift transaction. Utilize your basis for the part where you're going to pick up the gain. Use the rest of your, use some of your, you know, kind of those exemptions to get some of the other transfers in a tax-free methodology. And all of a sudden, you've been able to transfer a large chunk, gotten some cash back without having to kind of go all the way through in a generational planning methodology without actually getting any cash out of the deal, right? And so it really can be a nice, clean way to kind of cut some ties to some folks that are looking to make changes.
And Mike, for our viewers, a bargain sale, when we're talking about bargain sales, we're talking about a sale that's occurring at less than fair market value, right? So if you had the fair market value of a subject interest was $100,000 based on evaluation or some other data, and you transferred it for 50 grand, that's going to be considered, that would be considered a bargain sale, correct?
That's right. And so if it's between two disinterested third parties, somebody just got a great deal, right? However, when you do it to, let's say, a child, and you have a husband and wife owned company, well, now all of a sudden you've sold it for 50, they're getting exclusion for 30, and now they're only utilizing $20,000 of their personal exemption to really be able to get through it. So there's a lot of fun planning opportunities right now with that.
Yeah, I will tell you, you know, we're doing looking at a lot of valuations right now, and I will tell you the valuations aren't down as much as you might think. It depends a lot on the end of the business and industry. Obviously, hospitality and some other businesses were really strongly impacted, but you know, a lot in healthcare, but a lot of clients are not, you know, they just haven't seen a really dramatic impact in their revenues. Cancellation of indebtedness.
This is one that typically goes both ways, and it's really important to kind of think about. You know, so many people have had struggles with vendors, both either getting cash from their vendors or from, you know, their cash flow needing to maybe not be able to make all their payments to all their vendors and maybe had some of the amount of the balances due written off. It's really important to remember that there are tax ramifications when you call up, you know, one of your vendors and say, hey, you know, we're going to take, you know, $50,000 off the amount you owe us because you're going to pay us, you know, $120,000, and that's better in our pocket than not getting anything, right? And so what's really important here is that if you are getting rid of a receivable to somebody and it's in excess of $600, make sure you are you're providing them with the appropriate 1099 for cancellation of indebtedness income. So that way that validates your ability to take the deduction, right? It's a two-way stream there. If you write that off, but you don't file the 1099, it becomes a very challengeable fact to the IRS. But if you give the 1099, now all of a sudden it becomes a much more succinct and valid deduction.
And Mike, what's the threshold? What are the thresholds for those?
$600.
$600.
$600. Yep. On the other side, if you are a company that has received a relief from having to make a payment, corporations and S-corps and individuals, it's all determined at the company level. But partnerships is where it gets a little bit funky, because if a partnership gets relieved of an obligation to make a payment, it's actually determined that each individual partner or LLC member owners basis to determine whether or not they're insolvent for to avoid picking up income. So if you do get one of those 1099 fees yourself, or one of your vendors says that, hey, they're going to write off an amount that you owe them, it's really important to sit down and take some time and think about where that's going to hit and who's going to end up having to pick up that income. So even though it's canceled, it doesn't mean that you're getting off scot-free.
Yeah, no, great points. Employee stock option plan. So just a couple points here. You know, this is something that we get a lot of questions about, especially for, you know, we approach the end of another year. We've got a lot of small business owners out there who are you know, looking to divest, and they're looking for options. They're something that doesn't necessarily require them taking the business to market. ESOPs are available for most CNS corps. They allow for deductions of stock issued from Treasury. And there are just a lot of rules around ESOPs, one of which is they require the acquisition by a trust representing not less than 10 employees. So essentially this is, we think of stock option plans as being something that the venture capital guys use, or the tech companies use, or that the big multinationals use. There are options for ESOPs for small, closely held businesses, and typically they're done as a sale to a group of employees or all of the employees. There are a lot of pitfalls here, though. There are a lot of transaction costs. If the owner wants to cash out but stay involved in the business, all of a sudden you realize that you've now gained, a bunch of employee owners who are now essentially your partners or your shareholders, co-shareholders in the business. That can certainly be challenging. And there are a lot of just ongoing costs related to ESOPs, annual valuations that have to be done, attorney's fees. And I have been involved in several situations where, an ESOP was done, the business was really too small to support the multiple ownership, and the transaction cost just became a real burden, and unwinding the ESOP became a real burden. And I don't know, Mike, any other thoughts? I know this is something we get asked about constantly. It's something that I think is out there. It sounds interesting. It can be really difficult to make work well, but I don't know, thoughts?
Yeah, I think you hit it on the head. It's great if you are an employer who is selling to the employees and you're getting out clean, because you can kind of define your price and you can get some tax benefits, assuming it's structured right. Other than that, you are basically, it leaves a wake behind, right? To your point, Andrew, I have seen more ESOPs that have caused problems than I have that have been good long-term decisions, especially as that company grows. And one of the things you'll see is that, these companies grow at an accelerated rate afterwards. What they don't tell you is that they then get capped off, because eventually they go to do a merger, or they want to do a spin-off, or they want to do something else, and their ESOP doesn't let them do it because of all the rules and restrictions. And so while it might be good for, the first 5 or 6 years after the transaction, it becomes a real noose around the neck for many companies for the long term.
Yeah, absolutely. As we close in on 3:30 here, a couple more slides for our audience. Restructuring, Mike.
Yes. So as you think about year end, now is often the time that if you're thinking about either doing a spin-off, a division, gifting interest, you're thinking about maybe doing an add-on acquisition. Right now is the time that you should be getting into real serious conversations with your accounting and legal team about what that could look like, especially because there's oftentimes major savings from the IRS compliance side of closing a deal on 12/31 or on 1/1. It really changes the way that your methods and periods work. It gives simple cutoffs and a lot of other things. So, we're not going to get into divisive reorganizations or partnership divisions, anything like that. But I think the key here is that if you're thinking that you might want to make a change in the way that you structure your company, or the way that cash flow goes out to the shareholders or partners, now is the time to be having that conversation, not on December 1st. You really need to just be pushing forward on that.
Yeah, absolutely. And then I think our last topic for the day, new employee locations, something that, man, lots of companies are dealing with right now.
Yeah, so I think that's a great point. I don't think a day goes by that I don't get a phone call on one of these. And one of the areas that's becoming a concern is that as companies are no longer going to the same building anymore, they're hiring people in all different locations. And what they're forgetting is that when they send a laptop and a printer or a Wi-Fi station, or they reimburse them for use of part of their house as a quasi-rent supplement, for using part of their house as an employee location, things of that nature, there actually could be creating nexus in different states. And while a lot of people go, I've got 86-272 coverage, which is a very fancy argument that people make all the time about state and local taxation, what they're forgetting is that these distinct employees and small shop and small home offices, each state treats them differently. And I had a small company that has 15 employees, but they just hired 5 employees in 5 different states that are going to be working remotely. 3 of them ended up triggering sales and income tax nexus in those states, and 2 of them did not. And so it gets really complicated in these areas.
Yeah, lots of hidden pitfalls, lots of, you got to be very, very conscious of where your people are, whether or not you're going to trigger tangible personal property taxes, whether you're going to trigger income taxes, whether payroll tax reporting issues, just lots of potential issues to be on the lookout there. And I think, Nancy and Mike, that carries us through to 3:30. So we've had everybody here for a half an hour. Appreciate it. Nancy, I will turn it back over to you. Thanks, Mike.
Yeah. Thank you, Andrew and Michael. Andrew, could you go to the next slide? Thank you, audience, for joining us today. I know we had a delayed start, so thank you for sticking with us. But we hope you guys can join us next week for our next installment of the year-end tax planning webinar series. And this one's going to be on tax planning for individuals. And we're going to have Chris Dennett with us from Saltmarsh Financial Advisors to help do our presentation. But thank you again for joining us. You will receive a copy of the recording and the slide deck tomorrow in your email. So be sure to check your spam and junk folders in case it lands in there. But thank you again for joining us, and we hope you have a great rest of your day.
All right. Thanks, guys.
Bye.